So you've mapped your trade, you know where you're entering your trade. Now you need to protect your downside risk with an effective stop loss. And that stop loss needs to do two things. One, maximize your risk to reward on the trade so you can maximize your return. And two, protect your capital. So we're going to look at what is a stop loss and look at some of the top strategies for doing this. So what is a stop loss first and foremost? It's a price level where your trade idea is invalidated. So if price reaches this level, it's essentially saying you're wrong. Your trade idea is wrong. And so the stop loss helps you exit the trade and protect your capital. We're going to touch on this in series 3. But the big why around why you use stop losses is it comes down to risk management. One, we want to be out of the trade if we're wrong. But two, we want to always protect our downside risk. Because if we can control our risk and our risk to reward, we can build a profitable trading strategy. That's something we're going to cover next series. So these are our options, and these are the types of stop that I like to use. One, we put our stop below the swing point. That is probably the safest and easiest way to think about setting your stop loss. Two, stop below the higher time frame candle liquidation. This can work really effectively and give you higher R multiples. Or three, you go high risk and you stop by you put your stop covering the IRL zone you are trading. So maybe that's the fair value gap or the order block or the breaker block. But again, this is more high risk. So very quickly, if you're not familiar with how to set a position in the market, this is typically what it looks like. You want to enter your trade at the order block. So this is your entry point for the trade. Your stop loss is the point in which your trade idea becomes invalidated. So we have break above, retrace into the order block. So you're experiencing some drawdown, but you're not out of the trade unless price goes below this level. The purpose to then give you a return, an R multiple on your trade when you hit the high of your position. So if this is a -1, this makes a +2, for example, a 2R. We have 1% of downside risk, 2% of potential profit. So your risk to reward is 2R. We'll get into that again in more detail next series. Okay, so let's look at the example that we've been running through for the majority of this series. So let's first bring up the 1 week time frame. And we see, again, our context. So if you're just joining us here, this is the 12-hour price action. We are trading swing trades on the weekly, 2-weekly, and monthly time frame. So we have a bearish sell to buy, bearish weekly candle, expanding, retracing for continuations. Why is this high probability? Because one, if we look at the 2-week time frame, we see that this candle, this entire range, closed above its previous range. So we're looking for expansions to this high probability target. We wait for 1 week to confirm. We get accumulation, close above, creates the order block, manipulation into the low, close inside. Now we are going to distribute to the high probability target. So we have weekly accumulation, manipulation, and distribution. So this is our order block. We're now going to look at our entry, which we saw came from the order flow shift. Bearish order flow in, bullish order flow out. So we know we want to enter the trade here. We know that we want to target the continuation. So now we need to make a decision on our stop loss. So if we come back to this slide, we have a couple of options. One, stop goes at the swing point. So the swing point is the swing low of our price leg. So here's our bearish order block, which we can mark right here. So there is the last sell to buy. We also have a bullish fair value gap or price inefficiency right there, where we have creation of the order block, expansion upwards, third candle closes and leaves a gap in price. So our entry is at the fair value gap. Our swing point is the low of the price leg or order flow. which is right here at this low. So option 1 is we cover the swing low. So that's our trade, 2.5R. And honestly, if you have a target of around 2 or 2.5R for your trades, then this is by far the safest place to put your stop loss. Once we've seen this shift and manipulation, there is no reason for price to retrace because we've already liquidated this low. So this is very safe, very high probability trading in line with higher time frame context. You've got a 2.5R trade. However, we do have an additional option. We can just cover the higher time frame candle liquidation. So the whole purpose of this bearish order flow is to liquidate this candle's low. Price has already achieved that objective. So what is the reason for price to come down to this level? There is no reason. And actually, price wants to do the opposite. It wants to trap anyone that is getting short at this level. So let's imagine you're still bearish on this position and you're waiting for price to come into the internal range liquidity and then continue in the bearish direction. Well, price does not want to give you much chance to get out of your position. Yes, it wicks into the fair value gap, but straight away it's then aggressive because it's trapping traders that have got into a trade at this level. So there isn't really a reason for price to retrace, which means in theory we can increase or decrease our stop loss, however you want to look at it, to just cover the candle liquidation, which is here. So that is the liquidation. And that's what I mean when I say stop at higher time frame candle liquidation. So in this case, you've now increased your risk to reward, exactly the same analysis, exactly the same entry to a 4.64R. Okay, then we have another option, which is cover the IRL zone. So where are we trading from? We're trading from the fair value gap. So if you want to be very aggressive with your stop management, you could just take the zone itself. We are going to wick into the zone and then trade away. This would then turn the trade into a 15R trade. I can just say, as a quick disclaimer, I would never, ever, ever take this position, to be honest, because I'm trading the 12-hour time frame and I just don't need that stress. I don't want to just get wicked out. I don't need to be that greedy. I'm happy with, 4.5R would be amazing. A 2.5R is still an amazing swing trade. I don't need to be that specific or that detailed with my stop loss. We are going to cover something next, which is lower time frame entries, which might mean that actually you're waiting for price to retrace and you're looking for the exact same thing on a lower time frame. That's something different. That is waiting for lower time frame confirmation. So actually, you might get involved in this expansion, but because of lower time frames, you can cover that low because you have your confirmation and you can still trade towards those higher time frame targets. We'll get onto that next. Now, let's look at what happens in another scenario because this plays out perfectly. But what happens when something else happens? We look at the 2-week time frame. So we get, again, we looked at this earlier in the series, but this candle manipulated its previous accumulation candle right here. So price accumulates, price drives below the low, liquidates the low, and then targets the opposing end of the range, A, M, D. Accumulation, manipulation, and distribution to the high. If you wanted to get involved, as soon as you get this order flow right here, and you got involved in the exact same way that we did, we place our entry at the fair value gap. So we have last sell to buy, inefficiency between candle 1 and candle 3. You could cover the low. Then you have your target as the high. So you get here a 2R trade. We can also enter at the order block, so that gives you a better risk to reward. However, if you're taking the same logic that we did here, you're entering at the fair value gap. If you cover the swing point, you get this very bearish aggression, but you survive. You go into drawdown, you nearly get stopped out, but you take your 2R trade. If in this case you covered the liquidation, it's a 3.5 hour trade, but price wanted the order block. It wanted to drive lower to entice as many sellers into the market so that price could reverse against them as possible. So in this case, right analysis, wrong, stop loss, stopped out of the market. If you covered the IRL, the actual fair value gap, at this point, you get a 6.8 hour trade, but it gets stopped out immediately. You are just straight into drawdown, straight into your stop loss. So there is no hard and fast rule. You need to anticipate the strength of confluence at these areas. We had the order block to go higher, so the liquidation made sense as a stop loss, but we also had enough room to still get a 2.5R from the swing point. In this case, we're getting that bearish distribution. I'm not going to show you the higher time frame, but the monthly still had lower targets. So if you want to take this trade, probably best to take it cautiously, which means stop below the swing point. But again, there is no hard and fast rule here. It's about understanding context at the point you're going to take the trade and then making a decision as to where to enter and how to protect your downside. But once you've made your decision, stick to it. Don't jump between different options. Just make your decision, close your charts, and move on and get on with your day. Next, we're going to look at something more specific, which is lower time frame confirmation, where we're dropping down onto the 6, the 4, maybe even the 2 hour. Now, if this is something you're interested in, check out the next video.